Chapter 7 Homework. Before we dive into question 1, I'd like to review the accounting cycle. By now, all of you are familiar with the accounting cycle, but it helps to revisit it and refresh our brains as to what it is. There are a few different versions of the accounting cycle out there. Some of them just have 8 steps or 9 steps. This one is a 10-step cycle. They all have the same type of logic, but I think this 10-step one is the most comprehensive. So for step 1, you're going to analyze and identify transactions. What does that mean? That means that there are some events in a business that have an accounting effect and some don't. So we have to identify which ones have an effect, and then we determine which accounts they affect and what the amounts to be recorded will be. So first step is to identify a transaction. The next step is to create the journal entry. Remember that the journal entry is going to have at least a debit and a credit, sometimes more than one debit, sometimes more than one credit. And remember that these journal entries have to balance. So if you have $100 worth of debits, you also have to have $100 worth of credits. Then for step 3, we create T accounts. Remember that we're going to have accounts for assets, liabilities, and equity. Those are our permanent accounts. And then we also have temporary accounts like revenues and expenses, which get closed out every year. So that's step 3. Now this accounting cycle shows a circle of 10 steps, but really most businesses are going to cycle through steps 1 through 3 many times. So imagine a company like Target or Walmart. Every time they have a sale, they're going to identify that sale as a transaction. They're going to record a journal entry. Then they're going to post it to the general ledger. Then they're going to repeat that thousands or tens of thousands of times every day, over and over and over again. So really there's a mini cycle in this entire accounting cycle. Steps 1 through 3 are going to occur hundreds or thousands or even millions of times depending on the business. Now at the end of your period, you're going to prepare an unadjusted trial balance, which is where you have all of your T accounts and all of your journal entries, and all the debits and the credits should balance. Then you're going to prepare a worksheet, record your adjusting journal entries. Adjusting entries are going to be something like depreciation, where you may have purchased an asset a few years ago, so there's no actual cash or contract created in this period, but you have to depreciate your asset if it's a depreciable asset. So this is where you would record that depreciation. It can also be for prepaid expenses, where you've paid for something for several years and you record the portion of that expense that was used up in this period. Then you're going to create a second trial balance with these adjustments. And at this point, you're going to prepare your financial statements. And that's going to be your balance sheet and your income statement. Those are your 2 basic ones. And then some companies will also create a statement of cash flows and a statement of owner's equity. Now, after you create your financial statements, you're going to do your closing entries. Closing entries is where you close out your revenue and expense accounts and your other temporary accounts. Remember that expenses generally have a debit balance, so you're going to have to make a closing entry and credit those expense accounts to close them out. And then the opposite would be for the revenue accounts. And then finally, you have a post-closing trial balance where you balance everything out again and make sure that all your debits and credits equal. And then it's the start of the next period, and then you start the process all over again with step 1. Go through the cycle of steps 1, 2, and 3 as many times as you need to. Then you go to step 4, 5, 6, and so on and that's your accounting cycle. Now, why did I cover this now? The reason I covered it is because question number 1 deals with journal entries, and some people might feel like journal entries are a waste of time and they'd rather just crunch numbers, but journal entries are very important because when we're doing double entry accounting, we always need to make sure that our debits and our credits add up. Also, we need to figure out which accounts are going to be affected by a transaction and by how much. And so once we figure this stuff out, everything else is easy. The T accounts is easy, and then the trial balance and the financial statements are easy. So we need to really get our journal entries correct, and then everything else falls into place. So now let's start with question 1. Barker Products is a job shop. They give us 10 different transactions. They give us balances of our 3 inventory accounts: materials, work in process, and finished goods. And then they tell us how much our cost of goods sold, which is an expense, is for the period. And then they want us to prepare the journal entries and prepare the T accounts. So in this question, we have to prepare journal entries, but really, even if a question may not ask for journal entries, and you'll see some of those in this homework, it's still very helpful to create journal entries if you need to, just to keep things straight in your head. One other thing before we begin, this chapter introduces 2 new types of accounts. There's the manufacturing overhead control account and applied manufacturing overhead. The control account has a natural debit balance. That means that when you have your T accounts, most of your entries are going to be on the debit side. For applied overhead, you're going to make most of your entries on the credit side because it has a natural credit balance. In your overhead control account, you're going to record actual expenses. And in your applied overhead account, you're going to record applied overhead. And at the end of the period, you're going to have to reconcile these 2 accounts. In an ideal world, both of these accounts would equal, but in reality, they're probably not going to equal. So you have to figure out whether overhead was over-applied or under-applied. Then you have to adjust your inventory or expense accounts accordingly. And so we'll see how this applies when we create our journal entries. Event number 1, Barker Products purchased $13,000 of materials on account. So what's the journal entry for that? Materials is going to be part of inventory, so we're going to debit materials inventory for $13,000, and we're going to credit accounts payable for $13,000. So materials is an asset, and assets have a natural debit balance. Accounts payable is a liability, and liabilities have a natural credit balance. So hopefully you guys have that remembered. If you don't have that memorized, what I always focus on is cash. You know, they say that memorization is the lowest form of learning, which is true, but sometimes you do have to memorize something. The thing that I want you to memorize is how cash works. So when you get cash, when a company receives cash, that's a debit to cash. So any cash that you receive is a debit to cash. So that means that that goes on the left side of the T account. Anytime you pay cash, that's going to be a credit to cash. So just memorize that and learn how cash relates to everything else, and then you should be able to memorize whether or not an asset has a natural debit balance and whether or not the liability has a natural credit balance. It'll all make sense once you memorize cash. So for example, let's say you borrow $100 from the bank. Well, that means that you received cash, right? So that's going to be a debit to cash. Let's say you borrowed $1,000. And if you borrowed from the bank, that means you have to pay it back. That means that's a loan. So that's going to be a loan payable. So that's going to be a credit to loan payable. So if you can memorize that assets have a natural debit balance and liabilities have a natural credit balance, that's fine. But if you can't memorize that, at least memorize cash, and then you can figure the rest out. Part 2, you issued $14,500 in direct materials to the production department. So that means that you had inventory of $14,500, and now you're moving them to the production department. So that means that we're going to move the inventory out of the inventory account. So we're going to have to credit materials inventory, and our debit will be to work in process. And we're going to debit and credit by $14,500. Number 3, purchased $11,000 of materials on account. So again, we are purchasing materials, so that'll be a debit to materials inventory and credit to accounts payable. The question tells us that we didn't pay for the inventory, we put it on our account, so that'll be $11,000 debit to materials inventory and an $11,000 credit to accounts payable. If we did pay cash, what would the entry be? The entry would be a credit to cash instead of a credit to accounts payable. So again, if you can relate it to cash, you can figure out everything else. Number 4, we issued $900 of supplies from the materials inventory. So this one's a little bit tricky because this is not direct materials. That was like in part 2. This is supplies. Supplies is generally going to be an overhead expense. So we're going to use one of our new overhead accounts. For number 4, it says that we issued $900 of supplies. So remember that our manufacturing overhead control account is going to have actual numbers, not estimated and applied numbers. So we're going to debit manufacturing overhead control by $900, and we're going to take out $900 from materials inventory, because in this case the company keeps their direct materials and their supplies all in the inventory account, and as they use them, they either put them into work in process if it's a direct material, or they put them into this manufacturing overhead control account if it's an overhead expense. Number 5, paid for the materials purchased in transaction 1. Transaction 1, we bought $13,000 of inventory and we put it into accounts payable. So accounts payable has a debit balance. So to pay off the accounts payable, we're going to have to debit accounts payable by $13,000 and credit cash for $13,000. Number 7, we incurred direct labor costs of $22,000, which were credited to wages payable. That means that we're going to have a credit to wages payable. One thing to understand is we don't always have to do our debit entry first. We can do our credit if it makes sense, and that's what I'm doing here. I know that payables have a natural credit balance, so I'm going to do that one first. Wages payable, credit of $22,000. So what is my debit? So this is direct labor costs, which, as we know, is part of the cost of the goods. We're going to put it into work in process direct labor for $22,000. For number 8, again, we are taking supplies from the materials inventory, just like we did in number 4. So we're going to have manufacturing overhead control and credit materials inventory for $1,300. And number 9 is a little bit different. Number 9, we're applying the overhead, and we're applying it on the basis of 85% of $22,000 of direct labor cost. So remember that when we're applying overhead, we're going to use the account applied manufacturing overhead, and that has a natural credit balance. And we're going to debit work in process overhead, because overhead is ultimately applied to the cost of the products. We're doing 85% of 22,000, so I'm going to do equals 0.85 times 22,000, and that gives us 18,700. So that's our number 9 entry. And number 10, we recognize depreciation on property, plant, and equipment, PP&E, of 11,600. And remember, when we're doing actual expense numbers, we're going to debit manufacturing overhead control. And our credit is going to be to accumulated depreciation. And the question tells us that we're going to recognize depreciation of 11,600. So remember that expense accounts generally have a natural debit balance, so depreciation expense is a debit. Accumulated depreciation is a contra asset account, and it's where you record the depreciation that you've taken over the years on an asset. So you're going to record that as a credit balance. So accumulated depreciation is generally going to have a credit balance, which it does here. Now we're going to do our T accounts. And our T accounts should be pretty straightforward. Like I said, once you figure out what the journal entries are, the T accounts come naturally. So first, let's enter our beginning balances. The question gave us beginning balances for materials inventory of 31,700. So we'll put it here, 31,700. Remember, it has a natural debit balance since it's an asset. Work in process was 6,100. Finished goods was 32,000. And cost of goods sold was 52,100. But we'll work on that last. But let's begin with number 1. So number 1, our journal entry was a debit to materials inventory of 13,000. So we'll put here number 1, and we'll debit materials inventory for 13,000. And then in our accounts payable account, that'll be a credit entry of 13,000, and we'll put a number 1 there. Number 2, we had a debit to work in process direct materials of 14,500. Now for this client, they're not having a different account for direct materials work in process and direct labor work in process. It all goes into one account. So we'll put here number 2, 14,500 for direct materials work in process. And that came out of materials inventory, so that'll be a credit to materials inventory for 14,500. And so they're putting it all on the same line as number 1, which ultimately is fine. If I'm doing it myself, I like to put each transaction separate, so I would put this 14.5 on another line. But since we're working within the confines of the software, then we're going to do it the way that they want it. So that's number 2. Number 3, we have a debit to materials inventory of 11,000 and an accounts payable of 10,000. That's a debit, so we're going to have to put it here. Number 4 is the manufacturing overhead control account. So we have a debit of 900 and then a credit to materials inventory of 900. For number 5, looks like we labeled our worksheet wrong. So this transaction is number 5, accounts payable of 13,000 and cash credit of 13,000. Well, it looks like we skipped number 6, so let's do that real quick. Number 6 is that we paid 19,200 cash for utilities, power, equipment, and other miscellaneous items for the manufacturing plant. Utilities is going to be an overhead type of expense, so is power, equipment maintenance, and other miscellaneous items. So for number 6, tells us that we paid cash, so we're going to have a credit to cash of $19,200. And what are we going to debit? Since all of these expenses are overhead, and since these are actual expenses, we're going to debit manufacturing overhead control of $19,200. So for number 6, we're going to have a credit entry on our T account under cash for $19,200, and then our manufacturing overhead control account debited for $19,200. Number 7, we have a debit to work in process again for direct labor for $22,000, and a credit to wages payable for $22,000. Number 8, manufacturing overhead control debited for $1,300, and materials inventory is credited for $1,300. Number 9, we're applying manufacturing overhead $18,700, so we're going to credit $18,700 here and select number 9. Then number 10, we're recording depreciation, and so again, that's not applied overhead based on a predetermined amount. This is actual depreciation that we're recording. So those are our 10 events. We do need to take care of our cost of goods sold. So it says that cost of goods sold is $52,100. So that means that you must have taken $52,100 worth of finished goods out of the finished goods inventory. So remember that cost of goods sold is an expense and finished goods inventory is an asset. So when we record this, the entry should have looked like a cost of goods sold debit of $52,100, and finished goods inventory was credited for $52,100. So let's put that into our T accounts. So we started with $32,000 of finished goods. At some point, we transferred out $52,100, the cost of goods sold, and so that'll be a debit to cost of goods sold for $52,100. Now, one last thing to figure out is the question tells us that finished goods inventory ending is $29,500. So we have beginning inventory, ending inventory, and we know the transfers out was $52,100. So we need to know how much was transferred in. So remember our handy formula, beginning inventory plus either purchases or transfers in this case, minus transfers out equals ending inventory. So we know that our beginning inventory was $32,000. We don't know how much was transferred in from work in process, but we know that there was $52,000 transferred out, and we know that our ending balance is $29,500. So if we do the math and we move the $52,000 and the $32,000 over to the right side, we get $29,500 plus $52,000 minus $32,000. Our beginning balance is $32,000. We don't know our transfers in, but we know that our transfers out is $52,100. And the question tells us that our ending finished goods inventory is $29,500. So if we do the math, $29,500 plus $52,100 minus $32,000. So our transfers in is $49,600. So that means we must have completed $49,600 of goods. And so the entry for that would be finished goods inventory for $49,600, and then credit work in process for $49,600. So that's question number 1. It's a long question, but it's good practice. Question number 2 is going to be similar, so I'll let you do question number 2 on your own. Question number 3. Sturgis Manufacturing produces one model of precision tool and accounts for costs using a job cost system. For the most recent fiscal year, it tells us that total manufacturing cost was $2,578,125, and that's based on direct materials, direct labor, and applied manufacturing overhead. It tells us that total manufacturing cost was $2,578,125 based on actual direct materials, actual direct labor, and applied manufacturing overhead. And it tells us that 40% was comprised of direct costs. It also says that manufacturing overhead was applied to work in process at 250% of direct materials dollars. And it wants us to calculate the actual direct materials, the actual direct labor, and the applied manufacturing overhead. So for a problem like this, the best way is to convert all of the facts in the fact pattern into algebraic equations. That's really the best way to sort something like this out. So here it says that total manufacturing cost was $2,578,125. So we can put PC equals $2,578,125. It also tells us that total cost is comprised of actual direct materials plus actual direct labor plus applied overhead. That's another equation. It tells us that for the total manufacturing cost, 40% of that cost is direct cost. And so we know that direct cost equals direct labor plus direct materials. And we know that 40% of total cost, that would be 0.40 of total cost, equals direct cost. And finally, manufacturing overhead was applied at 250% of direct materials dollars. Well, for direct materials, they don't give us the number of units anyway, so all we have to work with is dollars in this situation. So 250%, that's the same as saying 2.5. So 2.5 times the direct materials equals overhead, right? Because again, it says manufacturing overhead is applied at 250% of direct materials. So you take 250% times direct materials and you get overhead. And so that's how you would write it out in an algebraic equation. 2.5 dm equals overhead. And now it wants us to calculate the direct materials used, direct labor used, and applied manufacturing overhead. So when we try to figure out a problem with multiple variables, we try to find the equation with just one variable. If you have an equation with multiple unknown variables, then you can't figure it out. But if you just have one, it's possible to be able to figure it out. So let's see what we know. We know that we're using total cost, direct materials, direct labor, and applied overhead. We don't know what direct material, direct labor, or applied overhead are at the moment. We don't have a solid amount for those. We do have a solid amount for total cost, $2,578,125. So that wouldn't really be helpful in this equation right now because there's too many variables. Total cost isn't part of this equation, but it is part of this equation. 0.40 of total cost equals direct cost. So let's plug that in here to see what our direct cost is going to be. So 0.40 times 2,578,125 equals direct cost. So direct cost must equal 2578125 times 0.4, and that equals 1,031,250. So now we know what direct costs are, and direct cost equals actual direct labor and actual direct material, but we don't know what either one of these are, direct labor and direct materials. We don't know. So even if we plug in that number here, it's not going to help us figure out one of these variables at the moment. But for this equation, it can actually help us, because remember that total cost equals actual direct material plus actual direct labor plus applied overhead. But we can substitute these first two variables for just direct cost. So we can change this equation to total cost equals direct cost plus applied overhead. And we know what direct costs are, and we know what total costs are. So we have 2,578,125 equals 1,031,250 plus applied overhead. So if we subtract 2,578,125 minus 1,031,250, we get that applied overhead equals 1,546,875. So we had to do a few sub-equations to be able to figure out a bigger one, but we have one of our variables now. So applied manufacturing overhead is here 1,546,875. Now that we know overhead, we can use the last equation that we created, which is 2.5 times direct materials equals applied overhead. So now we plug in our applied overhead number, and then we would divide that number by 2.5. So direct materials equals 618,750. So we plug that in here, 618,750. And so now we have two of our variables. So now we can use our long equation for figuring out the third variable. This total cost equals direct materials plus direct labor plus overhead. We know our total cost. We know our direct materials. We still don't know direct labor, but we're about to figure that out. And we know our overhead. So we get 412,500 for direct labor. So to check our work, we can add up all three numbers, 618,750 plus 412,500 plus 1,546,875. And we get the 2,578,125 that was given to us in the fact pattern. So hopefully your algebra skills weren't too rusty. A lot of people think that we don't use algebra after school, but we actually do. Algebra is used almost on an everyday basis, whether you're doing cost accounting or you're doing a recipe at your house. Any sort of calculation where you have an unknown variable that you're trying to solve is actually algebra. So we don't use calculus in our everyday lives. We don't use trigonometry, probably not too much chemistry, but we do use algebra every day. So hopefully you guys stay sharp on your algebra skills. Question 4. Skipping down to parts A and B before we read the fact pattern, it says that it wants us to figure out the amount of overhead that was assigned to 3 different jobs and whether or not the overhead was over-applied or under-applied. So now that we know what we're looking for, we can read the fact pattern and our attention will be alert to certain things. It says that Antoine Machining estimated its manufacturing overhead to be $279,000 and its direct materials cost to be $450,000 in year 1. So these two are estimates, the overhead and the materials cost. It worked on 3 jobs, AM002, I'll just say job 2 had direct materials cost of $15,000, $55,000 was for job 5, and $70,000 was for job 8. And then it gives us the actual manufacturing overhead of $313,000, and the actual direct materials cost was $540,000. It also says that manufacturing overhead was applied based on materials cost using predetermined rates. So when you see them use the term predetermined rates, you know that they're going to use the estimated figures to be applying these overhead costs. So the first thing we need to do is figure out what the overhead rate is. It tells us that we applied the overhead on the basis of direct materials costs using predetermined rates. So our overhead cost divided by the direct materials cost equals our predetermined rate. And so in this case, it would be $279,000 divided by $450,000. That gives us a 62% predetermined rate. So that means that whatever our direct materials cost is, we're going to multiply that by 62% to figure out how much overhead was applied to each job. We have job AM002, job AM005, and 008. For our DM costs, $15,000, $55,000, and $70,000. Our rate is 62%, which is the same thing as 0.62. And so we'll multiply the direct materials cost times the overhead rate to get our overhead applied. So that's our answer for number 4, part A, 9,300 overhead applied for job 2, 34,100 for job 5, and 43,400 for job 8. For part B, we need to figure out whether the overhead was over applied or under applied. So for this question, it seems to indicate that we didn't only have 3 jobs in this year, we had many more jobs. And the reason why it looks like that is because the direct materials costs for these 3 jobs were $15,000, $55,000, and $70,000. So that's about $150,000 worth of direct materials. But later on in the fact pattern, it tells us the total direct materials was $540,000. So that means that there were other jobs that the company had that they're not including in this fact pattern. So part A and B are not exactly related to each other. So we'll figure this out. So for part B, it says what was the over or under applied manufacturing overhead for year 1. So the question tells us that actual overhead was $313,000. But how much did we apply? We know that we're applying overhead based on direct materials cost. Total direct materials cost was $540,000. So overhead applied is total direct materials multiplied by our predetermined overhead rate of 62%. So that would be 540 times 0.62 equals 334,800. So our actual overhead was 313,000. We applied 334,000. We applied too much. We were over by 21,800. So that's your answer to part B. Question number 5. This question is related to question number 4. So in this question, it gives us the same facts of Antoine Machining about manufacturing overhead. direct materials cost for the 3 different jobs that it named, but it also gives us additional information. It shows that overhead applied in 3 different inventory accounts is work in process, inventory, finished goods, and cost of goods sold. Cost of goods sold isn't really an inventory account, so I'm not sure why it calls it that. It is related to inventory in the sense that it's the expense account which reflects inventory that's already been sold, but in and of itself, it's not an inventory account since inventory is an asset and cost of goods sold is not an asset, it's an expense. But in any event, that's what they call it. If we add up those 3 numbers, we actually get the amount that we calculated in the prior question, so that also indicates that the 2 problems are related. So 20,088 plus 63, 612 plus 251, 100. We get 334, 800 overhead applied, and that's the exact number that we got of applied overhead in the prior question. So in this question, they want us to do the journal entry to record the allocation of over or under applied overhead. So this journal entry is going to do 2 things. One is we're going to allocate the over applied overhead. Remember, it was over applied by 21,800. But we're also going to close out the manufacturing overhead applied account and the manufacturing overhead control account. So remember that the manufacturing overhead control account has a natural debit balance, and the manufacturing overhead applied account has a natural credit balance. So to close it out, you're going to have to credit the control account and debit the overhead applied account. So we can start with that. We'll debit the manufacturing overhead applied account by the 334,800 that we applied, and we'll credit the manufacturing overhead control account by the actual manufacturing overhead amount given to us in the fact pattern. I skip down to the bottom of the entry. You can actually do the debits and credits in any order, but I like to keep the debits on the top part of the entry and the credits at the bottom. That's how it's usually shown, even though it's technically not required to be like that. So just taking a look at these 2 entries alone, you see that manufacturing overhead applied was 334, the control account was 313, so here we see that it was over applied. And so when we have over applied overhead, we need to take out some of the overhead that was applied. And so we take it out of those inventory and expense accounts. Remember that inventory accounts are assets, and assets have a natural debit balance. So to take out the amounts, you're going to have to do credits. So we're going to take the amounts out of work in process, finished goods, and cost of goods sold. Now again, asset accounts and expense accounts have a natural debit balance, so to reduce it, we're going to have to put amounts in the credit column. But also, if you forget that, you just have to look at the way the entry is structured. You see that the debit side is already higher than the credit side, so to make the entry balance, you're going to have to put numbers in the credit side. So 2 ways to think about it. One is you want to make the entry balance, and 2, if you remember that asset and expense accounts have a natural debit balance, then to reduce those accounts, you're going to have to do credits. So we need to figure out how much we're going to enter into each of these 3 accounts. So to do that, we'll use our Excel spreadsheet. So we have the dollar figures which are applied to each of the inventory and expense accounts that were listed. So now we have to figure out what percentage of overhead was allocated to each account. So to do that, I'm going to do equals the work in process amount divided by the total amount. And for the total amount, I'm going to push F4, which adds these $ figures before the B and before the 5, and that will make it a hard reference. And I'll show you what that does in a second. And I'll change this column to percentage. So for work in process, it's the dollar figure to work in process divided by the total account. Now, if I drag this box down, it calculates the other percentages and it changes the reference accordingly. So for finished goods, if I push F2, it shows you that it changed the first cell to B3. For cost of goods sold, it changed it to B4. So this is what the hard reference. If you include a hard reference in a cell and you drag the cell down so the formula repeats, the formula with a hard reference will reference that exact cell for every copy of the formula. Now, if there is no hard reference, then Excel uses its AI, so to speak, to figure out and adjust the other cell references, but it will not adjust the cell reference if there is a hard reference in there with these $signs. All right, so we see that 6% of the overhead went to work in process, 6%, 19% went to finished goods, and 75% went to cost of goods sold. So for our over-applied overhead, we're also going to take the same percentage out of every one of these accounts. So if you recall from the prior question, we had applied overhead of $334,800. We had actual overhead of $313,000. So we had $21,800 over-applied overhead. So I'll just enter $21,800 in these three cells here. There's different ways to set up Excel, so set it up however you think is best and however you prefer. And so I'll do 6% times the $21,800. And so that means that work in process is going to have to be reduced by 1,308, finished goods by 4,142, and cost of goods sold by 16,350. And we can total these three numbers here to make sure that we got the right answer, which is 21,800. That was our total that we needed to reduce those three amounts by. So these are the figures that we're going to plug into our journal entry. 1,308 for work in process, 4,142 for finished goods, and 16,350 for cost of goods sold. 1,308 for work in process, and all of these are going to be on the credit side. 4,142 for finished goods, and 16,350 for cost of goods sold. Then we check our work, and everything looks good. So that's question 5. Questions 6 and 7 are similar, so I'll let you do that on your own. I might suggest doing question 7 first and then question 6, so it'll flow the same as 4 and 5 did. Question 8, that's also similar to questions 4, 5, 6, and 7, so I'll let you do question 8 on your own. Question 9. So this question, looking at parts A and B, it wants us to show labor and overhead cost flows through T accounts. And we see the T accounts here at the bottom: wages payable, work in process, cost of services billed. Cost of services billed is another term for cost of goods sold, except that cost of goods sold is used generally for a manufacturer or a retailer, and cost of services billed is going to be for a company that has more of a service type of product rather than actual physical goods. Service overhead control and applied service overhead. So these are the T accounts that we have to work with. And then it also wants us to prepare an income statement for the company for October. So let's look at the fact pattern now that we know what we need to look for. The fact pattern says that in October, TEP company planned events for 2 clients. Looks like their clients are Ward Corporation and Girardin Industries. They worked for Ward Corporation for 140 hours and worked for Girardin for 240 hours. They bill the clients $350 per hour. Labor cost for its planning staff is $140 per hour. Gives us the number of hours of work in October was 380, and overhead costs were $15,600. Overhead applied is $32 per planner hour, and in addition, we had $27,000 in marketing and administrative costs. So it wants us to record labor cost, applied service overhead, cost of services billed, and actual service overhead. So the first thing we need to do is remember our accounting cycle. We don't jump right to the T accounts. Remember our steps. The first step is to identify and analyze the transactions. Then our second step is to do the journal entries, and then we post these journal entries to the ledger. And this is where we would post it also to the T accounts. So before we can use our T accounts, we need to come up with the journal entries. Once we come up with the journal entries, then the T accounts will fall into place. So let's begin. To record labor cost, we first have to calculate what that cost is. And so it tells us that we charge $140 per hour, and we spent 140 hours for Ward Corporation. That would be $19,600. We also spent $140 per hour times 240 hours for the other client. That's $33,600. So $19,600 plus $33,600. That total is $53,200. So our journal entry for the first one is work in process of $53,200 and wages payable $53,200. Now, it is possible that a company will pay its wages in cash, but that's not usually the case. Usually, the company is going to record a wages payable, and then at the end of the payroll cycle, maybe in 2 weeks, then they pay the cash to their employees. Next is to record applied service overhead. Now, the fact pattern tells us that we are applying overhead of $32 per planner hour. So that's going to be $32 for the first job times 140 hours, which is $4,480. And then $32 times 240 hours for the other job is $76.80. The total for that is $12,160. So the journal entry for B would be to apply the overhead to work in process of $12,160 and then credit applied service overhead of $12,160. C is record cost of services billed. Now remember, this is the same thing as cost of goods sold. So the fact pattern tells us in the last line that all services were billed. So when services are billed, that means that we are done with our services. So what we do is we look at our work in process, see what's in that account. We have $53,200 in that account plus $12,160 in that account. So we have a total of $65,360. So when we're billing this amount, we're going to debit cost of services billed for $65,360 and credit work in process for $65,360. That's your journal entry for C. And then for part D, it's to record actual service overhead. The fact pattern tells us up here that overhead costs were $15,600. So we're going to debit service overhead control by $15,600. Now the fact pattern doesn't tell us how we paid for it, if we paid for it in cash or if we put it on account. Plus, also just looking at the T accounts, it doesn't tell us or give us any hints as to how they paid for it. It looks like in this case it's not going to matter, but just for the sake of completing our journal entry, let's just assume that they paid cash for their overhead costs. So that'll be a credit to cash for $15,600. I wish the question would have been more clear on how they paid for it, and so we could know the exact account to use and know how to set up the T account. But since they don't, we just have to do what we need to do to balance out the journal entry. So that's going to be your entry for D. So now that we have our 4 entries, we can fill out our T accounts accordingly. So the first entry was work in process debited by $53,200 and then credit wages payable by the same amount. So we'll start with our wages payable T account. It doesn't give us a beginning balance, so we'll assume that that's 0. We'll have a credit here for $53,200. Then our work in process, we're going to have a debit of $53,200. For B, we have a debit to work in process of $12,160. So we'll put that here. And applied service overhead credited for $12,160. And we'll designate it as the B transaction. For C, our cost of services billed is a debit of $65,360. Work in process is where the amount came from, so we're going to credit that $65,360. Once we do that, we see that our work in process balance is now 0. And then for D, we have a debit to service overhead control for $15,600. Now we don't have a cash account or any other type of payable account to credit at the moment, so we'll just leave this right here, just doing this first half of the entry. Now, one thing that the question doesn't mention, but we need to do, is our closing entry. Remember that we have to close out both overhead control accounts and applied accounts at the end of the period. So remember that service overhead control has a natural debit balance, and as we can see here, it does have a debit balance. So if we're going to close out that account, we're going to have to credit that amount. And then the opposite goes for applied service overhead account. It has a natural credit balance, so we're going to have to do a debit in order to close it out. So let's debit applied service overhead for $12,160, and we'll credit service overhead control for $15,600. So here we take a look and we see that we've applied only $12,160, but we incurred $15,600 in overhead costs. So that means we underapplied. So if we underapplied an expense, we're going to have to increase the amount of expense that we recognized. So what we're going to do is we're going to debit cost of services billed. Remember, that's an expense, and an expense is going to have a natural debit balance. So to increase an expense, we're going to have to add an additional debit. And also, we look at our journal entry and we see that it will have to be a debit in order to make both sides balance. So we'll do the $15,600 minus 12,160, and we get 3440. So that'll be our last journal entry we have to recognize in these T accounts. So for applied services overhead, we're going to do a closing entry here for 12160. For service overhead control, we're going to have to credit it by 15,600. And to make it balance, we're going to add a closing entry to cost of services billed of 3440. So now our T accounts are complete. Next, we complete our income statement. Now, a good example of this income statement is on page 298 of the book, Exhibit 7.13. So we'll just use that as a guide. The first line is going to be sales revenue. So we have to calculate sales revenue. Sales revenue, it tells us that we billed 380 hours and our rate is $350 per hour. And so that's $133,000. Our sales revenue, we're going to enter in this box. The next line, according to the exhibit, is cost of services billed. And the line after that is our service overhead that was over or under applied. We know that in our situation, it was under applied. So we're going to add that to our cost of services billed. So our cost of services billed was $65,360, and then we're going to add the under applied amount of $34,440. So $65,360 plus $34,440, that gives us $68,800. So our gross margin is $133 minus 68.8, and that gives us $64,200. Also, the facts tell us that we had $27,000 in marketing and administration costs. And so our operating profit is $64,200 minus $27,000, and that gives us $37,200. So we check our work, and it shows us that we had a typo here. So I'll fix that real quick. And now we're done. So that's question number 9. Question number 10 is similar to 9, so you guys can work on 10 on your own. And as usual, if you have any questions, please let me know.